Welcome to the WTR Small-Cap Spotlight Podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's podcast episode, I'm being joined by Brian Murphy, President and CEO, and Andy Fulmer, CFO, both of American Outdoor Brands, NASDAQ ticker symbol AOUT. American Outdoor Brands is an innovation company delivering product solutions for outdoor enthusiasts across hunting, fishing, camping, shooting, meat processing, outdoor cooking, and personal security. With 20 plus brands, including such well-known names as Bog, Bubba, Caldwell, and Crimson Trace, American Outdoor Brands serves the outdoor lifestyle and shooting sports markets. As an avid shooter myself from childhood, I have to say I have great respect for their brands. Also joining us is my colleague Doug Lane, Managing Director and Consumer Analyst at Water Tower Research. Good morning, Brian, Andy, and Doug, and thanks for joining me today.
Yeah, thanks, Tim.
Thank you, Tim.
So, Brian, this is your first podcast with Water Tower Research, so welcome, and always nice to talk to a fellow Lehman Brothers alum, even though we did not overlap. Please provide our audience with an overview of your professional background and how you ultimately landed at American Outdoor Brands, please.
Sure, yeah. So I like to joke, I am a recovering investment banker. So out of school, went into investment banking. I did healthy side M&A, mostly sell side for middle market companies at Houlihan Lokey. And that was my first foray into the deal world. Also spent some of that time doing restructuring work. So working with companies that were going through bankruptcy. But I got to see a lot of different management teams, different industries, different business models, things like that ultimately would come into play here at AOB. And but after investment banking, took a little detour. Always wanted to run something. When I was in investment banking, it always sort of bothered me to sit across the table from clients and give them advice about things they should do in their business when I hadn't run one myself. And so I had the opportunity to do that, but then eventually made my way into the buy side, working for a large aerospace defense publicly traded company called Alliant Tech Systems. And there I led acquisitions for that business, ultimately to build up one of its divisions and then spin it out. We merged the aerospace defense side with another company. But we created an outdoor, pure play outdoor company called Vista Outdoor. Which was public. It's no longer public. And then continued acquisitions for that business. But one of the things that just like, not having the operational experience in investment banking kind of bothered me. One of the things that bothered me when I was leading M&A was, I would go out and find these businesses that I thought were great fits. And then ultimately we'd bring them in and I'd hand it off to somebody else to sort of integrate and run that business and strategy. And so in 2016, Smith & Wesson reached out. They had acquired a few outdoor brands that were outside of firearms. And they said, hey, really interesting what you're doing over there. Would you ever have any interest in running the business, also leading acquisitions? And so for me, it was a perfect fit to be able to start with a clean slate, come over to Smith & Wesson, ultimately became AOB as a holding company. And from there was able to, in a way, eat my own cooking, right? Not only was I helping to lead acquisitions, but also run those businesses and formulate a strategy. And that strategy persists today. And I think it's a very unique one relative to some others in the space. And then we spun out from Smith & Wesson, this division that I was running in 2020 in the middle of COVID. And so I've been the president and CEO of that business since then.
What a great background. Thanks for sharing that. Andy, would you also please provide our audience with a quick flyby of your professional background?
Yeah, sure. So I started my career in public accounting at PwC. I was there for about 10 years. After a couple of years at a family-owned company, I went to Smith & Wesson. I was there for about 10 years, ending as the VP of Finance there in 2020. And at Smith, I was part of the team that acquired the platform and brands that Brian spoke about that comprised the outdoor products division that was ultimately spun off into AOB. So at the spinoff, I was named CFO, and it's been great ever since.
Excellent. Well, thanks, gentlemen, for those backgrounds. I'm excited to hear more about the story and the investment thesis. So I'll turn it over to you to ask questions, Doug.
All right, thanks, Tim. Yeah, you guys recently attended the SHOT Show in Las Vegas, where there was some new product news in the Caldwell shooting accessories line. Can you talk about what you announced there?
Yeah, sure. So SHOT Show, for those that aren't familiar, is stands for Shooting, Hunting, Outdoor Trade Show. It takes place in Vegas every year. It's like the Super Bowl of the primarily hunting and shooting space. And shooting sports for us represents just under about 50% of our total net sales. But it's a great opportunity for companies to launch new products and meet with their biggest retailers. And so we came out with a number of new products we do every year. But the one that I think got the most attention is with our Caldwell brand, which is our target shooting brand. And historically, Caldwell has been a brand that you take with you when you're going to do some target shooting at a range. So shooting arrests, hearing and eye protection, things like that. Ultimately, what's Caldwell trying to do? We're trying to eliminate the variables that make you miss. And this kind of speaks to, I think, our innovation approach, right? We haven't talked much about that yet. We have a very different approach to innovation than others do in our space. A lot of our competitors and companies in the outdoor industry, they really make slight modifications each year, little improvements. And our view is that those improvements kind of numb the pain for the consumer a little bit more, right? But ultimately don't move the industry forward. They just sort of solve these little problems. And I think that's great, but when we look at categories, we are really searching for contradictions. And there are contradictions all over the outdoor industry, where if you look at consensus about how to solve a problem with a product, a gear, versus reality, how the consumer actually wants to participate in that activity, oftentimes there's a big delta there. And so what we look for are these big markets, we say big sleepy markets. Shotgun sports within target shooting is one of those that we identified, about 20 million people. But the way that we're doing things with traditional clay throwers and clays doesn't match reality. The practice that people are trying to engage in there is ultimately they're going to be shooting at, most of the time, birds, and those birds have unpredictable flight patterns. And they're using this heavy equipment tethered to a car battery, which just seems like 30-year technology to do this practice. And so it's a contradiction that does not match what it's intended to do. So what we like to do, and this gets back to one of the major product launches at SHOT Show, is flip it on its head, right? How do we redefine how consumers are engaging in this activity in a way that more closely mirrors reality? And so we launched our product called the Claycopter last year, and then this year was an expansion of that. The Claycopter is really the exact opposite of what you'll find in the market today. It's a handheld launcher about the size of a megaphone. You can put one or two discs, we call them Claycopter discs, and it's got a lithium-ion powered battery pack. But you can put that thing anywhere and shoot one or two discs out, and they actually behave or mimic actual bird flight paths, right? They're not predictable. And so it completely changed the industry on its head, how it thinks about how to shoot targets there. And what's interesting for investors, I think, too, traditional clays you can't ship online because they're really fragile. And so you have to walk into a store to buy those clays. Well, because we've looked at it very differently, we stepped outside the frame. We now are the only company with targets that can be shipped online. And so that opens up a tremendous opportunity in market for new users, and then also just, I would say, more active users, people that are going out more often. And so the Claycopter family expanded at SHOT Show with our surface-to-air launcher, and it essentially allows you to shoot these discs out standalone, so it's surface-to-air. It can shoot one or two discs. It has a 50-disc hopper, but you can control it with your voice can control it with your iPhone or with a wireless remote. But what it does is it completely changes the game and adds gamification to a sport that hasn't seen gamification. You can now compete in real time against other people. And we think that's just going to expand the market even more.
Yeah, it sounds like these categories are really screaming for innovation, and that's a very good rundown of that introduction a couple of weeks ago. But new products is the story here. I mean, new products in general drove 31% of your second quarter sales. So step back and talk about how you prioritize your investments across your brand portfolio in its entirety.
Yeah, it's a question that a lot of companies that have multiple brands, they struggle with that question, right? If I have 20 brands, should I give the same love to all 20? And I think that is what people tend to do. They tend to peanut butter spread. Hey, all right, well, let's make sure everybody kind of has some love because we need to show progress. And we don't think about it that way. Instead, we prioritize based on these contradictions that I mentioned. And really, those serve as these sort of guiding lights for us to establish these beachhead products, which ultimately become families. So our priority is establishing those beachheads. If they are established, like the Claycopter family, now filling that out in a way where the consumer feels more comfortable changing the status quo. Hey, okay, well, now there's something I can use. I don't need to have somebody with me to launch these targets. Or, oh, I can invite more people with me on this event because we can set up a game. We can launch from multiple different throwers. So that really dictates how we look at innovation. We have a 3 to 5 year pipeline at any given time. It's a rolling pipeline, which is pretty extraordinary based on my experience. And we're also willing to shift things around. If we're starting to see traction in one area, we'll start to shift things around. But our product development teams play across all of our brands, whether it's fishing, hunting, shooting, etc. And what that allows them to do is cross-pollinate technology and IP in ways you normally wouldn't think you could do. And so that's how we prioritize most of our innovation.
You mentioned earlier about how important e-commerce is and getting the pigeon, the clay, being able to ship it on e-commerce, not just having to go into retail. But you talked about in the last quarter some evolution going on in the traditional retail channels, and it's impacting the e-commerce channels. So maybe just take a minute to talk about your distribution and what's going on there as far as the shift in the retail channels.
Yeah, I love that question. And no one really seems to be talking about it. So I think it's good that you're asking. So one of the things we've seen, we disaggregate our traditional revenue, traditional brick and mortar retailers versus our e-commerce only retailers. And historically, e-commerce revenue as a percent of total net sales can fluctuate, but call it roughly a third. It's been as high as 50%. But it does fluctuate. Well, the interesting thing is our traditional retail partners have been, I would say, consistently growing over the last couple of years. And if you listen to some of their earnings calls, you listen to Academy, you listen to Sportsman's Warehouse, you listen to Dick's Sporting Goods. What you're hearing over the last 9 or so months is foot traffic is a little soft, yet they're showing positive comps. And when they give some more data, what's driving that are their online sales. They consider their e-commerce channel, omni-channel, part of their same-store sales. So in many cases, that's been growing at double digits year over year. And so we're seeing the same thing. At the end of the day, we want to be where the consumer expects to find us. And after COVID, a lot of these retailers saw the need to play hurry up offense. Hey, we got to make sure our websites are at par, if not better than what the e-commerce only players are using. And they've done that. They've done that very quickly. And so now the consumer that has familiarity and trust with these retailers feels comfortable buying products directly from their websites. And we support both sides. But it has been interesting to see that evolution take place. And I think it would also be interesting to see how that changes going forward. What will e-commerce, let's say the Amazons of the world, what's their response going to be? going forward, because retail's not getting around, traditional retail.
No, that makes sense. Andy, you got a debt-free balance sheet. And so, how do you think about capital allocation between the organic growth and all the new products that you're investing in? Are there acquisitions on the horizon? And what about dividends and stock buybacks, just returning cash to shareholders?
Yeah, no, we are really proud that we've maintained a strong balance sheet. You see that in our Q2 filing. We had cash on hand, no outstanding borrowings on our $75 million line of credit. So yeah, we pride ourselves on maintaining that strong balance sheet. So on capital allocation, we really have three strategies, and I'll talk about them in order of importance to us. First and foremost is organic growth. Historically, we've been able to fund our organic growth and other key growth initiatives through our operating cash flow. So organic growth is by far the highest rate of return for us. And, we've seen the success we've had in launching innovative new products, the ones, that Brian has walked through. Next would be M&A. So we look for enthusiast brands that are complementary to our current portfolio, but also fit our innovation strategy. So we love companies with IP, just like us. We want to have that IP protection and those moats that Brian talked about. And then finally, share buybacks. In the absence of compelling acquisition opportunities, we'll repurchase our own shares when we feel as though they're undervalued. And our board has fully supported this strategy. So they approved a $10 million share repurchase program last September. That's good from October 2025 through September 2026. So if our shares are undervalued, I think you're going to see us keep repurchasing.
And your attitude towards dividends?
At this point, dividends probably are not on the table. As far as returning value back to shareholders, we prefer the share repurchase. But in the future, we'll assess that.
Well, share repurchases certainly give you more flexibility depending upon how the other paths of cash usage go. So that makes sense. And I would be remiss if I didn't ask about tariffs. So where are we with protecting gross margins and mitigating the tariff impacts?
Yeah, Andy, I can start if you want to jump in afterwards, but yeah, tariffs. Probably the most used word in media, I think, over the last 12 months. But yeah, tariffs continue to evolve. I think, not as rapidly as they did earlier in the year or early in the year last year. But for us, we've always really tried to structure our business, Andy and I, to have as much flexibility as possible. When rewind the clock between 2020 and 2022, maybe even in 2023, you saw a lot of M&A in our space. Just lots of acquisitions that were taking place where companies were buying businesses off of peak EBITDA and paying hefty multiples for that business. So what happened? They took on a lot of debt, and what that's led to as they've tried to delever is in many cases their EBITDA has come down from those peak levels. And so leverage has gone up. And so now they're having to sacrifice, business decisions, how to grow the business to prioritize debt payments. And so Andy and I were, back then we're like, hey, we got to be disciplined. We'd rather buy when there's blood in the streets than when everything is frothy. And so we were very disciplined during that time. But even though we did an acquisition, we paid off all of the debt. We're very conservative when it comes to that. But we're left in it with a balance sheet that gives us a lot of flexibility. So that's important when we're talking about tariffs, because we can make the best possible decision for our shareholders and our business that is aligned with our long-term strategy. So we didn't move right away. You heard reports of, hey, well, tariffs are going to 100+%. And you saw companies beginning to just move, right? Like very, very little planning, just begin to move as a reaction. And that wasn't our approach. Instead, we've taken a longer term view. We've moved where we think it makes sense for the long term. But one thing that we have that others don't is new products. So we, because it represents such a high share of our net sales, it's a tremendous, clever way for us to take price, right? But you're not increasing your existing line as much because you have these new products that don't have an established price. And so for us, we've been able to use that coupled with our supply chain flexibility to truly mitigate the impacts of the tariffs. So I don't know where they're going to go from here. Hopefully we'll see a refund. I think everybody does, but we're not counting on it. But because we have a clean balance sheet, because of our strategy around new products, innovation, I think we're really well suited for any additional changes that will come our way.
Oh, good. That's very helpful. Before we go, what should we be looking for as calendar 2026 unfolds? What's on the horizon for new product announcements? What's your cadence? What should we be looking for? And is there any more distribution expansion you can talk about on the horizon?
Yeah, 2026 is going to be a big year for us. We now have a few of these bigger product families that are taking shape that I talked about across fishing, hunting, shooting, outdoor cooking, meat processing. And so you're going to continue to see us coming out with new products throughout the year. The next big trade show is ICAST. That's like the SHOT Show of the fishing world that takes place in the summer. And you'll see a continuation of us really doubling down on gamification and subscription services, specifically tethered to a physical product. I think that's really important. And it adds to that stickiness. So you'll see us continue to emphasize subscription services, both on the fishing side and on the shooting side, in ways that have never been done before. We like to think of ourselves as Strava, if you're familiar with that brand. Strava, I think they just filed to go public recently, for the outdoor industry, for fishing, hunting, etc. So you'll see more of that. And then also, to your point, expanded distribution, right? We launched one of our brands, meat processing brand called Meet Your Maker, in 2020, and it's a play on words. I think I saw you smile there. But it's been a tremendous success. It went from zero, completely unknown brand, and through direct to consumer has risen to, I think the last time we reported on it, $15+ million in net sales. Well, the benefit of that is we've been able to generate a lot of pull through demand from consumers who want to walk into Academy, Bass Pro, and they expect to see Meet Your Maker on shelves. So we've seen tremendous expansion of distribution for brands like that. Also our most recent acquisition, Grilla, which is outdoor cooking, modular kitchens and cooking platforms. So I would expect that to continue in 2026. And so it's really, I think it's a 1-2 punch. It's continued innovation that is truly disruptive, and expansion of our brands, our existing brands, into areas where these retailers are noticing consumers are demanding them. Even in areas where you wouldn't expect, farm and home stores or DIY stores. We're seeing more and more consumers go into those locations as some retailers like Walmart has stepped away from certain categories. So I think it's going to be a great year. We're really excited to see our brands continue to evolve. And I think it's a great time to be an investor in this business. There's a lot of upside here.
Yeah, it sounds like you got a lot going on there. Well, I see we're coming up on time, so let me throw it back to Tim to wrap up here.
Thanks, Doug. Brian and Andy, before we wrap up, I have a couple just top of mind questions. I can't resist putting my former equity research sell side hat on. So I have a great appreciation for the size of the market in the U.S. for many of the sectors you're playing in. Can you speak to how large or robust those markets are offshore and your level of penetration? Is there some upside growth to be had there?
Yeah, it's good. It's a good question. And it's almost like a two-parter, right? It's like how much opportunity is there?
Sure.
And then you can't also help but consider the current political, economic environment, and geopolitical environment. So there is a tremendous upside internationally for us. We had, rewind to 2020 or so, international was about 3% of our total net sales. And we had to set a target out there for about 10%. And we reached that number or close to this last year. And so we saw tremendous adoption of shooting sports, but the United States is the leader when it comes to shooting sports. I mean, there's just such a big firearm market, right, with the Second Amendment. That said, the outdoor lifestyle side of our business, right, that's the other side versus shooting sports. Tremendous opportunity. So that's where we've seen a lot of our growth to reach that 10%. So things like outdoor cooking, grills, outdoor kitchens, meat processing equipment, tremendous opportunity there, where I could see that 10% long term being a bigger share of our business. And then geopolitically, continue to navigate those waters as they come up. But the great news about having the innovations that we do in the pipeline is there are still consumers out there that are demanding those products.
And then my curveball question for you to wrap up, as a fitness junkie, as you were talking about meat processing and cooking, there's not a week that goes by that you don't read something about protein, and food manufacturers obsessed with it. Are you seeing the needle move at all as consumers are becoming more aware of the importance of protein intake?
100%. 100%. It goes back to the contradiction statement I made earlier. What's the contradiction that we noticed in 2019, 2020? We have companies that are targeting people who grill, right? Cook their own meat. And then you have companies that target just people processing their own meat, oftentimes hunters. But what we began to see with like Joe Rogan and some of the other popular podcasters out there is this growing movement to know where your food comes from.
Right.
And that led to people, really starting to buy their own cows or, part of a cow and process that meat themselves. And there wasn't anybody out there that was talking to that consumer in a way that was field to table. And so to your point around protein, I think that's just like more recently kind of further provides a tailwind for consumers who are continuing to enter that market. And what's surprising, some of the research that we found, is where consumers are now expecting to find those types of products, right? I mean, that's just becoming a bigger part of their everyday lives. And so retail channels that you wouldn't expect would cater to that type of demand are now making choices to bring on brands like ours that are speaking to them. So that's a great observation you made.
That's great. The old saying, the trend is your friend. So Brian, Andy, and Doug, thanks so much for joining us today. I know our listeners will be excited to hear the story. So thanks and have a great year ahead.
Yeah, thank you so much.
Thanks, Tim.
Thanks, Doug. Thanks, Tim.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Small-Cap Spotlight Podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.